midnight on December 31st, 2025. While everyone else is watching the ball drop and ringing in the new year, the IRS is going to be watching your retirement accounts. Because the moment the calendar flips to January 1, 2026, the lowest tax brackets we have seen in modern American history will legally expire. And if you are over 60, this is not just a headline on the evening news. This is a direct, mechanical threat to the money you have spent your entire life saving. Right now, there are 3 specific assets sitting directly in the crosshairs of this change. If you leave them exactly where they are, held the exact same way you hold them today, you are quietly handing the government the legal right to take up to 40% of that money. Nobody at the IRS is going to call and warn you. Your bank isn't going to freeze your account to stop it. The money will simply vanish when you file your taxes. I am going to walk you through all 3 of these assets today. I will show you exactly what to move and where to move it. But I need you to pay very close attention when we get to asset number 2, because that is the one that catches almost every widow and widower completely by surprise, penalizing the surviving spouse in the exact year they need the money the most. My name is David Taylor. Welcome to Senior Money Brief. For years, I have sat at the kitchen table with hard-working retirees, looking at the fine print of the tax code. And the most painful thing I see is not the people who try to cheat the system. It's the honest, careful seniors who played by the rules their whole lives, paid their dues, and then watched their life savings get slashed simply because they didn't know a deadline was coming. So let's talk about this deadline. People are calling it the 2026 tax cliff. But I want to strip away the jargon and tell you exactly what that means for your wallet. Back in 2017, a massive tax overhaul was signed into law. It lowered income tax rates across the board. It expanded the standard deduction. It made it incredibly cheap to pull money out of your retirement accounts. But here is the catch that most people forgot or were never told in the first place. That law was temporary. It was written with a baked-in expiration date. It was designed to self-destruct at midnight on December 31st, 2025. This is not some proposed bill sitting in Congress waiting for a vote. It is already the law of the land. If Washington does absolutely nothing, if they just sit on their hands, your taxes are going up automatically on January 1st. The 12% tax bracket jumps to 15%. The 22% bracket jumps to 25%. The 24% bracket jumps to 28%. That might just sound like a few percentage points. But when you apply those percentages to your life savings, you are talking about tens of thousands of dollars leaving your family and going straight back to Washington. The IRS knows this is coming. The wealthy know this is coming. But the average senior living on a fixed income, pulling a little bit each month to cover the grocery bill and the property taxes, has no idea they are walking straight toward a cliff. Being legally required to pay a tax and voluntarily leaving your money in a trap are 2 different things. You have a shrinking window right now to reposition your money before the trap snaps shut. And that brings us to the very first asset you need to look at. It is the one sitting in almost every retiree's portfolio, and it is the absolute biggest target for the IRS in 2026. Asset number 1 is the traditional IRA and the 401k. And I need to be brutally honest with you about these accounts, because the financial industry rarely is. When you open your monthly statement at the kitchen table and see a balance of $100,000 or $300,000 or $500,000 sitting in that account, it is completely natural to think that money is yours. It is not. Every single dollar sitting in a traditional IRA or 401k is pre-tax money. That means you have not paid 1 dime of income tax on it yet. You essentially formed a silent partnership with the IRS decades ago. The deal was simple. They agreed not to tax you while you were working and raising your family, as long as they get to take their cut when you finally pull the money out in retirement. The fatal problem with that deal is that you let the IRS decide their own percentage. Right now, because of those 2017 tax cuts, the IRS is taking a historically small cut. If you pull $40,000 out of your IRA today to fix your roof, cover a medical emergency, or just live your life, you are paying taxes at the lowest rates we have seen in our lifetimes. But remember that midnight rule we just talked about. On January 1, 2026, those low rates disappear entirely. The IRS's percentage of your life savings goes up automatically. You did not make any more money. You did not change your lifestyle. You did not do a single thing wrong. But the silent partner in your retirement account just reached in and legally grabbed a bigger slice of the pie. Every dollar you withdraw to buy groceries, pay the utility bill, or keep the lights on is going to cost you more. And here is where seniors get trapped. You are legally required to start pulling money out of these accounts at a certain age. They are called Required Minimum Distributions, or RMDs. You cannot just leave the money sitting there to hide from the taxman. The government forces you to take it out. And starting in 2026, they are going to force you to take it out at a much higher, much more expensive tax rate. This is the pre-tax time bomb. You saved your whole life, you deferred the taxes, and now you are being forced to pay the bill right when the rates shoot up. But as expensive as this is going to be for you, it is absolutely nothing compared to what this exact same tax cliff is going to do to your spouse if you pass away. And that brings us to the most brutal trap in the entire tax code. If the IRA time bomb we just talked about worries you, this next part should make you fiercely protective of your family. In my line of work, we call this the widow's penalty. And it is the most brutal, silent income trap facing older Americans today. When you and your spouse file your taxes right now, you file jointly. You get a double standard deduction, and your tax brackets are incredibly wide. That means you can pull money from your pensions, your Social Security, and those pre-tax accounts without triggering a painful IRS bill. But let me ask you this. What happens when one spouse passes away? Usually the household income goes down. The smaller of the two Social Security checks completely disappears. But here is the cruel mathematical reality that nobody ever prepares you for. Your tax brackets do not just adjust down. They get sliced completely in half. The surviving spouse is suddenly forced to file as a single taxpayer. Even though there is less money coming in to pay the exact same property tax and the exact same utility bills, the IRS pushes the survivor into a much higher tax bracket much faster. Now, take that widow's penalty and drop it right into the middle of the 2026 tax cliff. On January 1st, 2026, those single-filer tax brackets are shrinking even further, and the percentage the government takes is going straight up. Picture a widow trying to maintain the home she lived in for 30 years. She goes to pull the exact same amount of money out of the retirement account that she and her husband used to pull together just to make ends meet. Because the 2026 tax cliff just hit, and because she is now filing single, that identical withdrawal could push her into a tax bracket that costs her thousands of dollars more than what they used to pay as a couple. She is paying significantly higher taxes, on less total income, in the exact year she needs financial security the most. You spend your whole life building a nest egg to protect the person sitting across the kitchen table from you. If you ignore this 2026 deadline, you are leaving them a massive tax burden instead of a shield. Income taxes on your savings are bad enough. But what about the physical things you spent decades working to pay off? That brings us to asset number 2. Asset number 2 is the one you are probably sitting inside right now. Your family home. For most older Americans, the house is the ultimate safety net. You spent 30 years paying off the mortgage. You watched the value climb. You assumed that if things ever got tight, or if you simply wanted to downsize into a smaller place that is easier to manage, you could sell the house and use that cash to securely fund the rest of your retirement. And under the current rules, you usually can. Right now, the tax code gives you a massive shield. If you sell your primary residence today, you can walk away with up to $250,000 of pure profit, completely tax-free, if you are filing single. If you are married, that tax-free shield doubles to $500,000. But when the 2026 tax cliff hits, the entire landscape around capital gains and real estate shifts. Because the overall income tax brackets are shrinking and rates are going up, the thresholds for when you start paying higher capital gains taxes are going to get much tighter. And if you combine that with the widow's penalty we just discussed, the trap gets vicious. If a spouse passes away and the survivor decides to hold on to the house for a few years before downsizing, that $500,000 tax shield drops straight back down to $250,000. If your home has doubled or tripled in value over the last few decades, waiting until after 2025 to sell could suddenly expose tens of thousands of dollars of your home equity to capital gains taxes that you simply would not owe if you made the exact same move today. And if you own a second property, maybe a small cabin, a duplex, or a piece of land you bought as an investment to sell later, the danger is immediate. Those secondary properties do not get the primary home tax shield. Every dollar of profit is taxed based on your regular income brackets. When those brackets snap back to the higher, more expensive rates on January 1st, 2026, the IRS's cut of your real estate sale gets significantly bigger. If you are planning to sell a property to fund your later years, you need to understand that doing it in 2026 will mathematically cost you much more than doing it right now. The government is quietly banking on you waiting. So, you have seen the threat to your retirement accounts. You understand the squeeze on your real estate. But the third asset is the one that makes me the most angry. Because this one does not just hurt you. It completely ruins the financial gift you intended to pass on to your children. Asset number 3 is the legacy you leave behind. And this is where the system stops just taxing your retirement and actively starts targeting your children. For decades, the traditional IRA was one of the most powerful ways to build family wealth. Under the old rules, if you passed away and left your IRA to your son or daughter, they were allowed to stretch out those withdrawals over their entire lifetime. It meant the money could keep growing tax-deferred, and they only paid a tiny sliver of taxes each year. It was a brilliant, legal way to protect your family. But a few years ago, Congress quietly killed the stretch IRA. They passed a law called the Secure Act, and they replaced that lifetime protection with something called the 10-year rule. If you leave a traditional IRA to an adult child today, the IRS strictly forbids them from stretching it out. They are legally forced to empty every single dollar from that account within 10 short years. And here is where the trap becomes absolutely devastating. Think about how old your kids will be when they inherit this money. They will likely be in their 40s, 50s, or 60s. Those are their peak earning years. They are already making the most money of their careers. Now, the government forces them to pull massive taxable withdrawals from your IRA and stack that money directly on top of their own salaries. Now, combine that forced 10-year window with the 2026 tax cliff. When the tax rates automatically jump on January 1, 2026, your children's income brackets are going to shrink. By forcing them to dump your life savings into their peak earning bank accounts under those new, brutally high tax rates, the government pushes them straight into the highest tax brackets possible. The IRS can easily wipe out up to 40% of the money you spent your whole life saving for them. It is essentially a massive inheritance tax, quietly disguised as an income tax. The government changed the rules on you, and they did it to ensure they get the final, largest cut of your life's work. So, you have seen the 3 traps. You see how the traditional IRA threatens you, how the capital gains rules threaten your home, and how the 10-year rule combined with this cliff threatens your kids. But you do not have to just sit there and take it. There is a legal firewall you can build right now. Let's look at the exact mechanism the wealthy use to completely disarm this cliff before the clock strikes midnight. This is the strategy that permanently protects your hard-earned money from Washington. The IRS built a massive tax trap for 2026. But they left the back door wide open, and right now, you still have time to walk right through it. This is where we stop playing defense and start playing offense. The wealthy do not sit around waiting for tax rates to go up. They proactively lock in the lowest rates possible while they still legally can. And the single most powerful tool to do that, the ultimate safe harbor against the 2026 tax cliff, is the Roth conversion. Let me explain this in plain English, because Wall Street loves to make it sound incredibly complicated. A Roth conversion is not a new investment. You are not buying a risky stock or changing what your money is invested in. You are simply changing the legal tax status of the money you already own. Here is exactly how it works. You take a portion of that pre-tax money sitting in your traditional IRA, the ticking time bomb we talked about in Chapter 2, and you voluntarily move it over to a Roth IRA. When you make that move, yes, you do have to pay income tax on the exact amount you shift. But here is the absolute genius of doing it right now. You are choosing to pay the tax today, at today's historically low, artificially cheap tax rates, before the 2026 cliff wipes those rates off the map forever. You are essentially buying out the IRS's silent partnership in your retirement account for pennies on the dollar. And once that money officially lands inside the Roth IRA, the real magic happens. It grows completely tax-free. When you pull it out to live on in your later years, it is tax-free. If tax rates double in 2026 or triple in 2030, it does not matter to you at all. The IRS is permanently, legally locked out of that money for the rest of your life. But it gets even better. Remember the widow's penalty we discussed earlier? If your surviving spouse needs to pull money from a Roth IRA to survive, it does not push them into a higher tax bracket, because Roth withdrawals do not count as taxable income. You have completely shielded them from the trap. And remember that brutal 10-year legacy trap for your kids? If they inherit a Roth IRA, they still have to empty the account within 10 years. But every single dollar they take out is 100% tax-free. You are passing on pure wealth, not a giant tax bill for them to choke on. By moving your money through the Roth conversion window before December 31st, 2025, you are flipping the script on the government. You force them to take their small cut now, so they can never touch your family's money again. But knowing about the Roth conversion is only step one. If you execute it incorrectly, you will trigger the exact taxes you are trying to avoid. You have to do this surgically. Here is exactly what you need to do this month. If you just call your broker today and say, "Move my entire IRA into a Roth," you are going to make a massive, catastrophic mistake. The IRS would love nothing more than for you to panic. Doing this wrong triggers the exact massive tax bill we are trying to avoid. You have to be surgical. You need a strategy, not a reaction. So here are the 3 specific moves you need to make this month, and the 1 giant mistake you must avoid at all costs. Move number 1. Calculate your current bracket room. This is the secret to making a Roth conversion work. You do not move all your money at once. Instead, you look at where your income is right now, today. Let's say you and your spouse are firmly inside the 22% tax bracket, and the 24% bracket does not start until your income hits around $200,000. If your current income from Social Security and a small pension is $150,000, you have $50,000 of room left inside that low 22% bracket. That $50,000 is your golden window. You convert exactly $50,000 from your traditional IRA to a Roth IRA. You fill up the room, and you stop right there. You do not cross the line into the next bracket. You are soaking up the lowest possible tax rates right up to the brim without tipping over. Which brings me to the giant warning. The biggest mistake seniors make is the all-at-once panic move. Do not take a $400,000 IRA and convert the whole thing on a Tuesday. If you do that, you will artificially spike your income for this year to $500,000. You will blast yourself straight into the highest tax brackets we have, triggering surcharges on your Medicare premiums and handing the IRS an absolute fortune. This is not a race to empty the account in one day. That leads us to move number 2. Shift the money gradually. We call this a multi-year conversion ladder. You calculate that bracket room I just mentioned, and you fill it up this year. Then, when the calendar turns to next year, you do it again. You are taking strategic bites out of the pre-tax IRA while the 2017 tax cuts are still active. You have between now and December 31st, 2025 to execute these strategic bites. Even if you only manage to move a portion of your savings before the cliff hits, every single dollar you get into the Roth side is a dollar the government can never touch again. Move number 3. Update the estate plan for the new rules. If you are planning to sell the family home down the line, or if you are leaving money to your children, you cannot rely on a will or a trust you wrote 10 years ago. The laws have completely changed. Sit down with a professional and explicitly ask them about the 2026 tax cliff. Ask them how the widow's penalty will affect your specific household. Make sure your beneficiaries are named correctly on these new Roth accounts, so that when your kids inherit the money, the 10-year clock starts on a tax-free account, not a taxable nightmare. We are running out of time on this clock. January 1st, 2026 is a hard, mathematical deadline. Do not wait for politicians to bicker and hope they magically fix this at the midnight hour. They created this trap, and they are counting on you being too confused or too distracted to walk right out of it. You have the roadmap now. You know about the pre-tax time bomb, the widow's penalty, and the legacy trap. Now it is on you to act. Let the Roth conversion be your shield, and let your family keep the money you worked so hard to save. If this briefing opened your eyes, do me a favor. Share it with someone you love who is over 60. They are walking into the exact same trap, and nobody is telling them either. My name is David Taylor with Senior Money Brief. Keep your money safe, and I will see you in the next one.